Hello and welcome to the Forex Freedom course. This Forex Freedom program is aimed at giving you all the necessary tools and information that will help you develop the required skills to trade the Forex markets. With the information packed in this program, we believe that with the right and proper application, your freedom, your financial freedom is guaranteed. Therefore, I encourage you to follow this program step by step, line by line, precept upon precept. Learn all that you can, break the lessons down to suit your timing and your schedules, but make sure you practice everything that you will learn in this program. And by the grace of God, we believe that your freedom in the Forex market is just a few moments away. In Introduction to Online Trading, historically speaking, Forex trading didn't start until the 1970s. But before the 1970s, there was a time when nations exchanged goods and services by the system of barter. With the barter system of trading, countries could only exchange goods for goods and services for services. For example, a country that was rich in cattle and needed columbite may have to look for another country that had columbites and needed their cattle. And where such country never needed their cattle, they had to look for or find out what they needed and look for a country that could provide or supply such a need so that they can find a way to get what they need from them. The system of barter was not a perfect system. No system is perfect in any case, but the flaws were too many. There were so many limitations in the barter system of exchange. Towards the end of the Second World War in 1944, Allied nations met at a conference in Bretton Woods, Northern Hampshire in USA, to fashion out ways and means of forestalling the post-World War menace that could be from Allied nations. It was at this conference that the International Monetary Fund, IMF, was formed. By the time the conference was over, member nations agreed that they were going to be exchanging goods and services with gold and the US dollar as benchmark. By this time, an ounce of gold was going for about $30 US. International trade began with the exchange of goods and services for gold and dollars. But by the early 1970s, the Nixon's administration in the United States of America felt they should stop backing the US dollar with gold. Hence, dollar became a currency. And as a result, floated rates of exchange was introduced. By floated rates of exchange, it implied that member nations could bring their local currencies into the international markets, bring their goods and services into international markets, and let the forces of supply and demand determine the rates or the strength or weakness of their economies. Since currencies serve like thermometer, serve like this for measuring the economic health of any country. By the 1970s, trading had already begun with some exchanges in operation, but was limited to just high net worth individuals and organizations. And as of 1980, history has it that about 70 billion US dollars was turned over on a daily basis in the Forex market. And by this time, transactions were carried out through telex and telephones. But by the mid-1990s, all thanks to the Clinton-Al Gore administration, the internet was birthed, and this also saw through the emergence of online Forex brokers. These brokers had to gather traders from around the world and put their funds into segregated accounts that allowed them to place orders in the interbank market. Remember, Forex trading is also known as interbank trading or over-the-counter trading because physical presence is not required to carry out transactions in the Forex market. Today, there have been emergence of many brokers, and some have become extinct already. And with the emergence of brokers who now serve as middle agents or dealers, the requirement for entry came down. To operate a standard account, you needed $100,000, and to operate a mini account, you needed $10,000. Then there was nothing like micro accounts. But with the emergence of brokers, leverage was introduced as a means of helping those with low income or low trading accounts or funds to also tap into the huge Forex market. Hence, it more or less like became an all-comers affair with low entry now in place. Also, micro accounts were introduced. Traders could now choose brokers of their choice, send money to them, and gain access into the Forex trading markets, into the Forex market through the platforms provided by these brokers. Today, over $4 trillion US dollars is turned over in the Forex market, telling you that there's so much abundance in the market. And with this, the implication is that there's no need to be in a hurry. If you miss an opportunity, there will still be more opportunities ahead. Therefore, do not hurt yourself. Do not blow your accounts because you missed a trade. Always realize that there is abundance in the Forex market with $4 trillion daily turnover, bigger than nearly all the stock exchanges in the whole world put together. Their turnover in 1 week is not up to $4 trillion. How about legal issues about online trading in Nigeria? Well, the Forex market is one highly unregulated market the world over, more so now that it's traded over the internet. In many countries of the world, there are no regulations. Just in a few countries like the United States, where the National Futures Association and the Commodities Futures Trading Commission regulate. Also, in the United Kingdom, you have the Financial Services Authority, FSA. NFA, National Futures Association, is for US. CFTC, that's Commodity Futures Trading Commission for US. FSA is for the United Kingdom. And of course, you have some others that regulate them in Switzerland, in Germany, Belgium, and a few other countries. However, in Nigeria, being a new line of business and the internet relatively new in Nigeria, there are no legal issues regarding online trading. However, suffice to say that the idea of going to collect funds from people to trade may be illegal if you do not have the operating license. So I can conclude that there are no legal issues about online trading in Nigeria except for those who go about collecting funds from people in the name of fund managers without licenses, operating licenses, and registrations, the necessary registrations. Therefore, if you want to trade funds for other people, for the members of the public, go through the appropriate quarters, do the necessary registrations, and collect the necessary operating licenses. The trading platform used in Forex trading, one of them and one of the most popular is the MetaTrader 4 trading platform. Already MetaTrader 5 is out, but we still trade on MetaTrader 4. Very shortly, I'll be taking you through the MetaTrader 4 trading platform features. But before we do that, we'll be looking at what fundamental analysis is. Technical analysis, what is it? I'll be explaining them before I go back into the trading platform and, of course, the Forex market, what, why, where, and when. So, what is fundamental analysis? In Forex trading, there are basically two broad types of analysis. The first is the fundamental analysis, which involves the use of economic data to predict or forecast the movement of currencies in the market. Such economic data include interest rate statements, inflationary statements, gross domestic products, international trade, current balance, and all of that, current account balance rather, and all of that. Well, we can categorize these economic indicators into micro and macroeconomic indices. The macroeconomic indices being the factors, economic factors that have to do with the economy on a larger scale, where government is involved, for instance, interest rates, while the microeconomic indices have to do with what individuals, citizens do within the economy. For example, when the buying power of consumers in an economy go up or down, currency's strength is affected. Consumer price index, producer price index, all these are inflationary indicators. These are economic indicators that point to inflation. And then you have the technical analysis. Technical analysis is the use of charts to analyze or examine the markets to generate information. So note, fundamental analysis is the use of economic, micro and macroeconomic indices to generate information about the Forex market, while technical analysis is the use of charts, historical charts, to generate information about the markets. Then you have the three basic trading styles. They include the day trader, the position trader, and the swing trader. Well, if you place them in order, you have the day trader, you have the swing trader, and the position trader. The day trader the day trader is a trader who opens positions and closes them the same day. It doesn't allow the trade to roll into the next day. And among the traders, you have the scalpers, you have trend followers, and you have breakout traders. Then the swing trader. This is the trader who can open position and leave it for more than a day to several days and weeks. And the position trader is the trader that can examine the market in a longer time, on a longer time basis, and they can open positions and leave them to run for months and even years. So note, the swing trader can allow positions to run between 1 or 2 days, 3 days, 1 week, and several weeks, while the position trader allows trades to run for months and even into years.